here with you today, and Mary Lois and I are looking forward to talking with you about not only some of the trends in the industry, but some of the more effective ways that you can manage your marketing mix. And I think one of the most important things that you're going to want to hear is this great case study that Mary Lois is going to talk with you about in a moment. So let's talk for a moment about what we'll cover today. First, how to increase marketing efficiency and to really improve your optimization around your marketing and sales channels. And one of the things that I know I've been hearing in the room and hearing from many of you is, the world is changing. We have more channels than ever before in terms of not only sales and distribution channels, but also more channels in terms of the marketing mix. How do we kind of manage this and optimize this and manage it as part of our overall business mix? Secondly, as we're trying to figure this all out, there's so much data that's available. There's so much that we hear in terms of from speakers and from providers at these different conferences. What's really important and what really matters? How do we leverage all of that and kind of focus on the things that are really going to be able to make a difference for us? We're going to talk about how one community bank really retooled its approach. And then finally, how to really sell your CEO and CFO on the real value. And I was struck yesterday with Ray Davis, when Ray Davis made the comment of we need the CMO in the room. Spontaneous applause broke out throughout the session. And so we're going to talk about that specifically, about how to craft your work and craft your analytics so that they really provide the value to your institution, and the marketing group is seen beyond just we run the advertising to we really provide the revenue value to the corporation. So with that, I want to kind of shift a bit to go back in time. And I have 4 millennial children, and whenever I tell them about the way it was, this is what they tell me. They said, I get it, back when dinosaurs roamed the earth, this is the way things were. And so, to illustrate my little story in this, I was a newly minted MBA, and what is now one of the large trillionaire banks hired me and said, you go and run, we're going to give you this portion of mail programs to run. And what really was important to them was direct mail programs, because that was a really tangible thing that we could really focus on, and we knew the value that came out of that. And something that, at least for banks, maybe less so for credit unions, but at least for banks, where do our CEOs and CFOs come from? They typically come from a commercial lending experience. They're numbers people. They can relate to that. They can relate to the fact of you put the mail out there, it drives this level of return. It's a measurable kind of thing. And I became pretty good at that. This is a 957-page handbook of direct mail. If you ever find this as a doorstop in some used bookstore, you'll find me in chapter 9. And we could measure this stuff in terms of what it drove, because we knew the cost, and this is still true, obviously, of direct mail. We knew the cost. It was a little bit simplistic, but basically we knew the cost. We knew what kind of came in from it. We could kind of calculate the value. We spent this much, we got this much. So I did a good job at that, and I got promoted to a larger marketing group that was more commercially oriented. And those guys didn't care about this. They wanted to said, take them out on golf games. We've got skyboxes and more money than we spent on the consumer side. We've got skyboxes. We even had a skybox at the rodeo in Dallas. And, there's a certain amount, I guess, of truth of if you lock people up in a skybox and you provide them with food and you provide them with liquor, that you're going to probably get some business out of that. But it's one of those things that it just kind of illustrated at the time of how do we measure this and how do we kind of figure this out other than the feel-good portion? And that's still to a certain extent true today, isn't it? As we have more channels and as we have more ways that we deliver value or deliver information to customers, some of it is just hard to measure. We know it kind of pays off, but at what level does it pay off and how much investment and effort should we put behind it? And then we started talking about, we'll wow our customers. We'll learn from Disney and we'll provide value to them because we provide a better customer experience. And they'll be delighted, and because they're delighted, that they'll do more business with us. And of course that's true. All of these things are. And we have CEOs and CFOs who started to ask, as the mix got more diverse, well, what do we get the value out of this? It's all good stuff, but how much should I invest in it? And these new programs require infrastructure upgrades. They require better data, or they require that we send people to training. We were at Umpqua Bank at Ritz-Carlton, for example, and we spend money on that. And the CIOs wanted to know who's paying for this. It all sounds familiar, doesn't it? I mean, it's the same issues that we have today, really. They just were in a little different context. And we as marketers struggle to explain the shift from, we created awareness, it brought familiarity, people considered us, and out of that consideration set, we got a certain amount of purchase, and that created loyalty. It was a pretty linear arrangement in terms of how we thought about this. And I'm not trying to, I know a little oversimplification, but nevertheless, it was a funnel that we can understand. And while that's still true today, this mix has become more like this burden or this spaghetti wire arrangement, where we don't always know where the direction that customers go and how they hear about us and think about us. So if you think about the kind of shift, as you know so well, think about the shift of, we used to talk about when a customer complains or they have a problem, it influences maybe 10 other people. Well, today it can influence thousands or multiples of thousands, especially if they're particularly interesting in terms of their tweet. It can go viral and can have much greater impact than I told my neighbors, either to the positive or negative side. So let's think for a second about what this all means for you and for us as marketers. The drivers of purchase are changing. Branch distribution still is, while changing, still is the key. If you've got leverage in distribution and access, then that is the most important driver of how people think about where they want to do their banking experience or which credit union that they want to join. It's an issue of convenience really matters, even as those behaviors are shifting. Whether that will still be true 20 years from now, or to the degree that it will be true, I think is a matter of significant debate. But we still know that at least today, having that presence and having convenience matters to people when they choose what bank they're going to deal with. But marketing is increasingly becoming, in terms of share of voice, almost equal to distribution when it comes to influencing how people choose a bank, where they stay, where they choose to do their depth of relationship. National competition is increasingly becoming an important part of the mix simply because of the consolidation of banks. That in the past we were less likely to have a Bank of America, a Chase, or a Wells Fargo, or a large regional bank like Fifth Third or PNC across the street from us. Today, because of the consolidation in most markets, that's, except in the smallest of markets, that's not the case. They have big leverage. But the shift is changing. And marketing is becoming a far more important leverage point and important share of influencer in terms of who banks with you and how you create that loyalty with them. And that means that the CMO's role has changed. That this is from Ad Age just a couple of weeks ago, talking about how ad chiefs are turning into chief revenue officers. And I always thought when I see, even though my experience has been running branches and running distribution, that when I hear that banks change the title of essentially the head of distribution to be the head of retail banking, to be the chief revenue officer, I often think, isn't that what a marketing or a CMO should be, as the chief revenue officer for the bank? And how do they get that seat at the table and be able to provide that contribution and be seen as the driver of revenue, not just the person who executes against the marketing budget? This places greater emphasis on, not just in terms of the analytics, but how the analytics are integrated into the way that the bank operates or that your credit union operates. And it creates greater emphasis in terms of executive skills and corporate strategy. And that's some of the things that we're going to talk about today, and particularly with highlighting a case study that Marilois is going to talk about that is going to illustrate this, and then we're going to highlight at the end some of the practical implications for making this work at your institution.
I want to just talk a little bit first about the consumer journey, and this is going to be important because I want you to continue to visualize this as we talk about our solutions along the way. You know, in addition to that path to purchase being more sort of circular, as David showed, the media journey is much more fragmented. I mean, this is just a day in the life of mom. She's on her mobile phone. Now she's waking up with Alexa and asking for news. She's listening to the radio in her car. She's maybe exposed to billboards or out-of-home digital billboards at the doctor's office. She's going to school online. She's networking with colleagues or at the PTA. She's watching TV. She's on social media. I mean, this is just a little bit of that day. And then in the midst of all that, there are these emotional drivers that frame her relationship with the brand. It's how she perceives the brand. It's the word of mouth from her friends and family. It's perhaps a sense of rationality about a purchase and about a brand. Is this something I need, or is this something that I want? Is this a sexy Apple product, or is this something more commoditized? There might be some inertia. How easily accessible is this product? And then there's this noise from all the competition. So what we wanted to do is figure out, at the end of the day, the budget pie hasn't gotten any bigger. The slices have just gotten a lot skinnier. The first thing that we wanted to do is look at our data. What data is available? I hate to use the word data audit because that sounds really scary, but we did a data analysis. And you might be surprised to find that you actually have a lot of data. It just sits in different silos. And very often those team members don't talk to one another. So we wanted to break that down. Once we did our analysis, we realized we had impression data, so paid media. We had owned media from our PR team. We call that from our social media work, our owned media. We had earned media, press coverage, so the PR agency and the PR team had kept track of that. We were able to use third-party research to pull competitive media spend and share of voice. We had some brand tracking data, so we wanted to understand what is the unaided awareness, and that's for both ourselves and our competitors. And then the other touch point that we felt was important was branch distribution, because if a consumer has to drive past 10 Bank of Americas before they get to you, that's going to be an important touch point. So we mapped that and included that as a variable. And then, of course, the sales results. So I want to encourage you, because a lot of brands at first blush think, okay, we don't possibly have this, we haven't started to collect it. Number one, I encourage you to start to collect it. And then secondly, you may be surprised at what you have or how easily it is to obtain this. Focused on 3 products, we built and calibrated the model, and then we socialized the findings. And socialized just means, built a presentation to graph the data. It was a little bit, more tricky, but I don't want to discourage you, because it is really, really empowering to do this. And we were able to come up with some really great solutions. Okay, well, what is the lift by that media channel versus the investment as sort of a precursor to an ROI calculation? So in this case, we see that display and paid search are real winners. I mean, we see a 16% lift versus an 8% share of the pie. So paid search, for instance, is 5% of your overall media investment, but it's creating 7% lift. This is for consumer checking. Business checking is a little bit different. We see some different winners. We see online video, we see trade. Native was a real winner with business checking, and that was something that was eye-opening for us, because our consumer insights research had said native is a great way to engage B2B, but we weren't really sure how to measure that. So that was really helpful. And then home equity, I showed you this because you may have noticed on the other slides that direct mail, you want me to go back, wasn't necessarily the winner that you might think it is. You look at direct mail for lift versus investment for consumer checking. And there had been that sort of that Michael Phelps, disproportionate credit for direct mail, because you can count back the names to the list and the closed ones to the list. So that was eye-opening to understand that direct mail doesn't perform the same for each of the product lines. So then the next question is, well, what is the synergistic effect? Because we saw that TV might have had a higher cost per incremental sale than, say, search engine marketing, but we also don't want to spend our entire budget on search engine marketing. We can't build brand that way. So by running a synergy report, this is all coming from the model, we can see that the combination of TV with direct mail is higher. They feed each other, and so it's greater than the sum of their individual parts. So the results, we've had year-over-year increases in sales with a flat to, in some cases, lowered overall media budget. And that's just simply by redeploying investments from underperforming areas to higher performing areas. Ultimately, it changed the way the bank did business. It quantified the value of brand. I mean, to be able to present to executive leadership what the cost per was by television, what the synergistic effect was of television, was a huge win for the marketing team. It changed the strategy to include more integration across media channels. I think very often marketers are looking for that silver bullet, and they want to sort of analyze each media channel in a silo. This was a way to show that the more integrated your campaign is, the more impactful it can be. It challenged assumptions around the ROI of direct mail, and that was mind blown for some of the not only marketing team but executive leadership team. The sales growth was 3 times the industry average of competitors in the region, so that was a win for the marketing team as well. And it connected the data from all that lived in all those different silos. If you ran a brand tracking study and you can see that your unaided awareness has increased by 12%, that's great, but what does that mean? And it was actually a really nice team building opportunity for all of the different departments to work together on this project.
Mary Lois, this is a great transition point to say a lot of this looks really complicated because some of it is. But how do you do this and what are the critical building blocks? Whether you're a large organization or a small organization, the building blocks are fundamentally the same. They just may be sized differently.
Right.
And let's talk through some of the suggestions in terms of some of the lessons learned from this analysis in terms of operationally, not just mechanically and tactically how to do it, but operationally how to think about your organization and the leverage points.
The first word of advice I would give is to just kind of level set everyone's use of language. I mean, we discovered seasonality didn't mean the same thing for the engineer as it did for the bank. So our engineer interpreted seasonality to mean when we have a snow event and the branches are closed, whereas the sales team knew seasonality meant there's certain times of year where products have greater demand than others times of year. And then identify the internal customers, the CFO, or in our case it was the CEO, and explain the methodology and the blueprint for this plan to get buy-in. So the second lesson is align on objectives. This isn't like a TurboTax where you just sort of plug in numbers and spit out reports. You really want to talk through what the objective is. I also caution to think through one answer at a time because, when I ask marketers what they want, they say, I want you to tell me what the optimal media plan is that's going to increase sales. And that's a multiple varied proposition. So in our case, you could sort of see the iterative process that we underwent where we looked at the lift to investment, we looked at the synergy, we looked at the sensitivity, and then finally we put everything together into a media mix to forecast, all right, with this new media mix, what will our sales be? So have patience for that. Which products have priority because as we discovered, marketing isn't one solution for every single product. The consumer journey is different for each product. The marketing solution is different for each product. If you've ever used a Waze app, you can know that it's incredibly accurate at giving you an ETA. I mean, I live on Cape Cod. I flew out of Boston in the heart of traffic hour, and my ETA was within 3 minutes of the initial estimation. But sometimes an accident happens, storm pops up, and so you have to adjust course. I think that's a great analogy for this. It's a journey, it's an iterative process. Schedule frequent check-ins. That's a lesson we learned the hard way, is that we needed, because the data is coming from different departments, we needed to give ourselves more time to say, why are the numbers looking funky? Why is the simulation, why is that MAPE not fitting? And then just make sure that you're inclusive of all the silos that house the data. We talked about the consumers and their mindsets, that inertia, that rationality. The other lesson is to challenge your own mindsets because you want to pay attention to the sacred cows and be prepared to challenge them, but at the same token, you want to pay attention to the wisdom of the group. So, for instance, we found that home equity had a much higher consideration from direct mail for a variety of reasons. So we wanted to adjust the calibration in the model for that. And that's something that we wouldn't have seen in the data, but we knew from the sales team who had a lot of experience with it. So start simple, gain efficiencies, learn lessons, and build on the model. Just in summary, this is a great picture slide. Not all team members speak the same language. Not everyone desires the same objective. Again, the PR team might want to know how are our efforts helping sales. The branding team might want to understand, well, how are we increasing unaided awareness? The CFO wants to know what is everything that you're doing impacting sales and how can we get more sales? So just explore possibilities. Like I said, sometimes one answer can lead to a new question. So, wow, we saw TV has this great synergistic effect, and the cost per incremental account wasn't nearly as high as we thought it would be. So, but how much more should we invest in TV? So that's sort of how that iterative process can happen. And then, as I said, it can include some salesmanship, and you have this great opportunity to communicate the value prop to the team and look like a hero at your bank, and then just be prepared to challenge the sacred cows.
You've got tons of data within your credit union or within your bank. The issue is how do you unlock it or how do you make sense of it? And I think the steps that Marilois was talking about gain alignment at the beginning, talk about what data is available and meaningful, starting off as a non-starter, starting off to say we've got to invest in upgrading our systems is a non-starter. It may be something that you want to do, but it's not a place to start. Otherwise, you'll never get going. But there's enough data that's available, enough ways to kind of pull it in and gain value out of it to be able to make significant progress. It may then reveal other opportunities for you to go forward.
So you'd say that kind of starting with the external measurement can then help you to make the case that you need to improve internal measurement.
Yeah.
Well, and I would say there's lots of internal data available. It may not be perfect.
Yeah,
it
it's
may not
getting
fit all,
done.
but there's
Yeah,
still plenty that you can use.
If you're finding, for instance, that your digital marketing is driving leads, and then your CRM system is closing them, and you're getting more efficient in your digital spend, and you're getting, then you might want to upgrade your CRM system. But we kind of started from the top in terms of channel efficiency. Yes.
How long did the project take?
This took us 6 months. And the thing is, the kind of cool thing is this would have cost $1 gajillion a few years ago and been really unwieldy, and only the largest brands could have it. But now with cloud computing and machine learning modeling, we're able to do this really affordably, and with a smaller size bank where you've got that evangelist who can quickly deploy across channels, you can get it done much more quickly. And then once you have the model built, then it's just tweaks year over year. So